planning, wealth management, financial planning, money management, estate planning, and will planning. We have catered to over 1 lakh plus clients, not only in India, but also abroad. And let me introduce you to the speaker for the day, Ms. Nidhi Manchanda. She is the head of training, development, and research at Fintu, with a decade of experience in teaching, coaching, mentoring, working professionals with their personal finance and investments. And today we'll be talking about how you can utilize your losses on your investments to reduce your taxes and increase your in-hand income. So over to you, Nidhi.
Yeah, thank you, Nawaz. A very good afternoon to everyone. So, as you all are aware, today we'll be discussing about one strategy which you can use in current market scenario when you see a lot of volatility in the market. So, sometimes you see that your portfolio is actually going down, you're experiencing certain losses. So how you can turn this disadvantage of seeing losses into your advantage and save your taxes. So that is what a strategy called tax loss harvesting is. And this is what we'll be discussing in today's sessions. We'll keep it, very short, as in the explanation of what this tax loss harvesting is all about. And towards the end, feel free to ask any of the questions that you have in your mind. So you can park those questions in the Q&A as well. Okay, so we'll talk about this. Now, before I start with this, as I discussed, that, if you are investing into the markets, we have seen that the market has been very volatile, this year. So in case you have, invested and you have made profits, sometimes you have made losses. So in this regard, one question that I would like to ask all of you, how many of you are investing into share market right now? Can you let me know in the chat, yes or a no? People who are investing into share markets, it could be directly through stocks, or you're investing into particular large cap stocks, mid cap, small cap stocks, or it could be also through mutual fund route. You are investing into equity asset class through mutual funds. So you maybe have invested into equity mutual funds, or any large cap fund, or a large and a mid cap fund, or any ELSS fund. So some equity exposure if you have in this year into equity. Okay, so I can see so many people are saying yes, you are investing. Okay, yes, but not now for long term. Okay, that's fine, Vinay. So I have some old investments. That is fine if you are doing it for long term, or even if it's a short term investment for few months or a year investment, that is also fine. So basically, what we'll see is that if you are investing into the share market, how much tax you are supposed to pay. So like so many of you are already investing into share market, either through mutual funds or directly. Can any one of you just mention in the chat how much tax you're supposed to pay on your equity investments? How much tax you're supposed to pay on your equity investments? So basically, when we talk about equity investments taxation, we have two things. It is long-term and short-term. So you can tell me, how much you need to pay for long-term and how much you need to pay for short-term. Okay, 15% short-term, 10% long-term, 10% long-term, 20% for short-term, 15%. Not sure, is it on the profit amount? Okay, no problem. Even if you're not sure, few of you have just, written it correctly. So when we talk about equity investments, like I said, it depends upon when you're selling your equity investment, your shares or your equity mutual funds, whether you are selling it in short term or whether you are selling it in long term, that will define how much tax you need to pay on your investments. Now, how would you understand whether it is short term or long term? So basically, this is based on a time horizon of 12 months. So in case you are selling your investments within 12 months, and whatever profit or loss you are incurring, realizing the profit or loss, that is called as your short-term gain or a short-term loss. But in case you are selling your investment after holding it for 12 months or more, in that case, whatever gain or loss that you will have will be termed as long-term capital gain or long-term capital loss. So now let us see that. So like I mentioned, short term and long term, less than 12 months short term, more than equal to or more than 12 months is long term. For short term, you need to pay a tax of 15% on the gain amount. That's a flat tax rate that is applied on your short term capital gains. If it is a long term capital gain, then up to 1 lakh of long term capital gain in equity markets is exempt from tax in the entire financial year. Any gain over and above that will be attracting a tax of 10%. This is how your equity investments are taxed. On the other hand, if I also talk about debt investments, where we talk about debt mutual funds, there also there's a concept of short term and long term. But here, short term and long term is based on the time period of 36 months. So if you are selling your investments within 36 months, it is short term, where the taxation will be as per your tax slab. So if you are opting for, let's say, old tax regime, you could be in 5%, 20%, 30% tax regime. Accordingly, you will have to pay tax on that short-term capital gain. On the other hand, if it is long-term capital gain, you are selling your debt mutual funds after holding it for 36 months or more. In that case, you will have long-term capital gain, and here the taxation would be 20%. But after you get the indexation benefit. So indexation benefit is nothing but you will get the benefit of inflation. So your investment value will not be just the value that you have invested, but that will be inflated, and then the gain amount will be calculated. And on that 20% you will have to pay. So it's not, it will be much lesser than flat 20%, because indexation benefit also you are getting here. So that is what the taxation is. But the question is here that, can we save this tax? If you are investing into the markets and we are sometimes getting gains, losses, can we do something to save this tax? That's the strategy. That is what we are going to discuss in today's session here. Okay, let me know if you have any questions so far on the taxation part. I'll move forward in the meantime. So like I mentioned, we'll be talking about tax loss harvesting. Now, why this? The main concept here is you are investing into the stock market, you are investing into the markets, you are making gains or loss. So whenever you are making a gain, you will have to pay tax. How much tax you need to pay? We have just discussed. You have to pay around 15% in short term and 10% in long term after 1 lakh is exempt. So this is how much tax you need to pay. But a strategy called tax loss harvesting is something which you can use to reduce or just make your gains zero, so that there is no taxation that you need to pay on this. So that's what the strategy is about. Most effective way of planning your taxes without any evasion of tax. So here we are not avoiding to pay any tax. It is very much legal to use this tax loss harvesting technique. We will be using the things that are there. They are written on in the Income Tax Act. We are just making ourselves more aware about those things, making use of it, and try to reduce our taxes at maximum level. Okay, so that's what tax loss harvesting is. But let us understand this with the help of an example. If I just explain you the theory part of it, I think it will be a little difficult to understand how it actually works. So let's understand this with the help of one case study, one example. So let's say there's one person, Rahul. Okay. Now this person has made certain equity investments in the financial year 2022-23. So currently we are in this financial year starting April 2022. We are in the month of December. 3 more months are left. But in this financial year, this person Rahul has made certain investments in equity market. Now let us see what investments he has made. So here, if we talk about these investments, so these are the 3 investments: equity share A, equity share B, and equity mutual fund 1. He made these 3 transactions wherein he invested 5 lakh rupees and he sold this investment or redeemed this investment, redeemed these shares at a price of 4,50,000. So that was the first transaction that he did this year. Second is he invested some amount in another share at 6 lakhs and the value went up and he sold this investment at 9 lakhs. Then equity mutual fund, he invested into one mutual fund also, 4 lakh rupees, and this amount has gone up to 4,50,000. So again, these are just assumptions. So let's say here, if we talk about the entire all the 3 transactions together, 15 lakhs is what he had invested. And when he sold these investment, he has actually realized 18 lakhs. So in total, if I see how much is the gain, total 15 lakhs is what this person has invested. Rahul has invested 15 lakh rupees. And in the same financial year, he has also sold these investment at different price levels as mentioned on the slide and got 18 lakhs. So total 3 lakhs is what this person has made a gain. Okay. Now, if I talk about this, so here if you can see in the first investment, there is a loss of 50,000. In the next investment, there is a gain of 3 lakhs. And in the last investment, again, there is a gain of 50,000. So gain of total 3,50,000 and a loss of 50,000. But if I just set it off, and for the financial year, if I find out the total, it is net 3 lakhs of profit. Now, can you tell me how much tax he's supposed to pay on this 3 lakhs, considering this is short-term capital gain? All the 3 transactions are short-term. So how much tax he need to pay on this 3 lakhs? How much tax the person needs to pay on this 3 lakhs? 20%. No, Vinay. Like I mentioned, 15% would be the correct answer. Yes, Khushbu, you're right. 15% is what this person has to pay. Rahul needs to pay 15%. Correct. Yes, many of you have just guessed it correct. Sanjay saying right, 45,000 is the actual tax amount that the person will need to pay. So how much tax Mr. Rahul will have to pay? Like most of you have guessed, 3 lakhs at 15%. Like I've already discussed, that 15% is the short-term capital gain tax that you need to pay. 45,000 is the tax outgo. I hope till here it is clear. We're talking about a person, Rahul. He made 3 transactions. He made profit in 2, loss in 1, but net to net, he's getting a profit of 3 lakhs. At the end of the financial year, if he sees that in this financial year, I have made a profit of 3 lakhs, he's supposed to pay capital gain tax on it. Now, because this is short term in nature, 15% is the tax rate. So 45,000 is what he needs to pay. Now the question comes, can Mr. Rahul save this tax? Is there any way which he can use to save this tax? The answer is yes. That's what the strategy is, tax loss harvesting. Now, what he needs to do to adapt to this strategy? So basically what Rahul needs to check is, these are the 3 transactions that he already made, and he made total net profit he has booked of 3 lakhs. But what about his other investments? Can we see his portfolio and see if he's making, any profit or loss in any of the other investment that he hold already? So if we look at his portfolio, now he also has 3 more investments. So there is one equity share X, equity share Y, and there's another mutual fund that is holding right now. Now in this particular investment, he has made investment of 5 lakhs in the first one, 6 lakhs in the second one, and 4 lakhs in the mutual fund. Now the current market value of these 3 investment is 9 lakhs, 9 lakhs, and 2 lakhs respectively. So the first one in share X, he invested 5 lakhs. Now the current market value is 9 lakhs. So he is making a profit. Second one, he's invested 6 lakhs and it has also become 9 lakhs. So here also there's a profit of 3 lakhs. Now the equity mutual fund investment that he's holding, where he has invested 4 lakhs, has gone down to 2 lakhs. There is a loss. Total, if we see, there's a 15 lakh of investment, and which is unrealized net profit, if we see, is around 5 lakhs. The total amount is 20 lakhs. Now, when we have to adopt a tax loss harvesting strategy, the strategy itself has a word loss. So what you need to do is, you need to check the portfolio and see, is there any investment where I'm making a loss? Although I've not sold my investment, I've not realized the loss. It's a notional loss that you have. So is there any investment which is making a loss? We'll have to figure it out in the portfolio. So for all of you also here who is making any profit, who have already booked some profit on your investments, you're supposed to pay tax on your profit. Now, in order to save that tax, what you need to do is you check your portfolio. Is there any other stock, any other equity mutual fund, any other investment wherein you are making a loss? You'll have to just identify that particular share or mutual fund. So here in this case, which one is the investment where the person is making a loss? So if I talk about X, there is a profit. In share Y, there is a profit. But in mutual fund 2, there is a loss. Okay. Now what needs to be done is, you need to sell this equity mutual fund 2. So second equity mutual fund you need to sell. What will happen is, once you sell this investment, you are booking a loss of 2 lakhs. Okay. So 4 lakhs is what you invested. Now you're selling it at 2 lakhs. What you're doing is, you are booking a loss of 2 lakhs. So you'll have to book a loss. So once you book a loss of 2 lakhs, let's come back to our 3 original transactions which are already done. So 50,000 loss, 3 lakhs profit, 50,000 profit, net to net 3 lakhs profit was already there. But now because we have booked another investment with a loss of 2 lakhs, our net profit for this financial year reduces to 1 lakh. Okay. So because there, see, since if you will not sell your investment, the loss is already there. But because you have not sold it, you cannot set it off against any of your profits to reduce your tax outgo. But if you book your loss, you can set it off against your profits and can actually reduce your tax outgo. Here in this example, I'm showing that there is a loss of 2 lakhs, which you can set it off against a gain of total 3 lakhs. So your net profit reduces to 1 lakh. There could also be certain instances where your entire profit gets set off against losses and you will not have to pay any tax. But in this case, because 3 lakhs profit is already there, 2 lakhs loss you will book. Net now is 1 lakh. Now, how much tax you need to pay on this 1 lakh? Anyone here? How much tax you need to pay on this 1 lakh? Yes, great, Mervin. So basically 15,000 is the tax. Correct. Arna, Shivram, Vikhyat, yes, all of you guessed it right. 15,000, simple calculation, how it came. 1 lakh is the gain. 15% you need to pay on this short-term capital gain tax, so 15,000. So earlier, because you have booked a profit, or Rahul has booked a profit of 3 lakhs, net profit, he was supposed to pay a tax of 45,000. But because he identified his in portfolio, he found out there is one investment which is making a loss. Why not realize this loss and set it off against the profit? So once he has done that, his tax liability reduces to 15,000. So 30,000 rupees saved here. This is just one example to make you understand how it works. It could also be zero in case you have made a loss of 3 lakhs somewhere, you book that loss, so you do not have to pay any tax at all. So this is something which you can use. But again, the strategy is not complete yet. So once we have identified a loss, we have booked that loss. Now, because we have booked that loss, we have set it off against our profit. But we had invested into a particular share or a particular mutual fund for a long-term perspective, right? So because we have exited from that particular investment, it is very important that we re-enter also at the same time, right? So what you need to do is, before you have sold or before you have applied the tax loss harvesting technique, your portfolio was 20 lakhs, right? Now here also, let's say first one, now equity share X, you already have 9 lakhs current market value, share Y is already there. But what you did is, mutual fund 2 you sold at 2 lakhs. You have to purchase it again. So you'll have to invest 2 lakhs again in the market. Now, when you are making that investment again, you can do it in 2 days time. So, once you do that investment again, you can just look at, if there's a slight correction, you can invest it at a lower price as well. But again, do not try to time the market and try to see that, I'll enter, at much lower price and then you lose opportunity. Just make sure that whenever you are re-entering the market, it is at the same level or slightly less level so that it covers up your brokerage or STT paid as well. So re-enter, and once you have done with these two transactions, selling and purchasing again, what you can see is, again, you will have your portfolio of 20 lakhs itself. Now, very important thing here is, once you have sold your investment, it happens that, once the money gets into your bank account, you will think twice that, should I reinvest it again? So that should not happen, that, once it is sold, you are utilizing it for something else and not reinvesting. This entire thing you're doing just to save your taxes. So you'll have to reinvest that money again into the markets. That is really important that you're supposed to do. I hope it is clear till now. Any questions, anything which is not clear? So what we are doing is, however the market is performing, we are just taking a position. We are just realizing that loss, although the loss is already there. But now what I'm doing is, I'm just booking that loss, taking the money, and again I'm reinvesting that money again. That is what I'm doing. So here, once I'm doing that transaction, re-entering the market again, my portfolio remains the same, but I have saved my taxes. This is what the strategy is. I hope it is clear to everyone. If you have any questions, you can tell me. You can park that question in Q&A. one more concept that I would like to, explain here, just summarizing the entire tax loss harvesting. And there's another concept which is very important to discuss. So what happens here is tax loss harvesting. I repeat again, what we have done is we have booked our notional loss into actual loss to reduce the tax on realized gains. Investing in the same fund on the same day as on sale to maintain the value of the portfolio. So not exactly on the same day, but in T+1, T+2, whenever you're getting that money, you can invest. Or if you already have some additional cash with you in your bank account, then you can also do it on the same day in some other stock and some other mutual fund, or with some other demat account also. If you have more than one demat account, you can do it with other demat account, then you can do it with in the same day as well. So you can take that exposure, and this should be done before ending of the financial year, that is 31st March 2023. So we still have more than 3 months if you want to execute this strategy. So whatever profits that you have made in the financial year 2022-2023, you can set it off against the losses made in the year. But if you have not booked any losses till now, you can just check your portfolio, identify any investments which is making a loss, book it as a actual loss, and then set it off against your profits to make use of this strategy. I hope this is clear. Now, when it comes to set off, we are discussing what that, I have made a profit, I have made a loss, let's set it off and save our taxes. But it is not very straightforward, and it is not very simple in that sense that you can directly set it off any profit with any loss. So there are again certain rules under Income Tax Act which prescribes that which profit you can set off against which loss. Not every profit can be set off against every loss. So these are some guidelines that you need to keep in mind when you are executing your tax loss harvesting strategy for yourself. Okay. Now let us understand what these strategies are. First is, let's talk about, there are two things that we have understood: short term and long term. Now in short term, there could be loss also, there could be gain also. So let's first talk about short term capital loss. Now, if I have a short term capital loss, can I set it off against short term capital gain? Everyone, can you tell me in the chat? आप चैट में बता सकते हैं कि हम सेट ऑफ कर सकते हैं शॉर्ट टर्म कैपिटल लॉस विद शॉर्ट टर्म कैपिटल गेन? Yes. Anyone thinks no, we cannot do that? Yes, I think so. Okay. Just to confirm it, yes, you can do it. Short-term capital loss can be set off against short-term capital gain. What about short-term capital loss against long-term capital gain? Short-term capital loss को long-term capital gain के against set off कर सकते हैं हम? Yes or no? Okay, you're saying no, not possible, no. Someone is saying yes. Okay, no. Okay, so here we have mixed answers. Don't know. That is fine. Short-term capital loss you can set off against long-term capital gain as well. तो अगर आपका शॉर्ट टर्म कैपिटल लॉस है तो आप शॉर्ट टर्म कैपिटल गेन के अगेंस्ट भी सेट ऑफ कर सकते हो और लॉन्ग टर्म कैपिटल गेन के अगेंस्ट भी सेट ऑफ कर सकते हो. बोथ आर पॉसिबल. इट इज एज पर द इनकम टैक्स एक्ट. नाउ लेट्स टॉक अबाउट लॉन्ग टर्म कैपिटल लॉस. Can we set off long-term capital loss against short-term capital gain? What do you think? No. Okay. Mervin is saying no. Okay. Pragati is also saying no. Rashmi is saying no. Adiki is saying no. Shivram is saying no. Okay. Mostly everyone is saying no. Fine. All are correct. You cannot do that. But what about long-term capital loss against long-term capital gain? Can we do that? Can we set off there? Yes, we can set it off here. So this is something which is very important for you to understand. If you have a short-term capital loss, you can set it off against any gain, be it short-term or long-term. But if you have a long-term capital loss, you can set it off against only long-term capital gain and not short-term. This is what you need to keep in mind. In order to understand this in more detail, if you have long-term capital loss, you are allowed to set it off against only long-term capital gains, but not short-term capital gains, no intraday gains, no any other business profit. So you cannot set it off against any other thing, just the long-term. If it comes to short-term capital loss, you can set it off against long-term as well as short-term. but not against intraday or any other business income that you have. Okay. If you have any business loss, if you are doing any business and you're doing some business, then in that case, you can allow to set it off from long-term and short-term or any business profit, but not allowed to set off from business profit intraday one. Last one, if you are doing intraday and you have any profit or losses, we are talking about losses here. It is termed as a speculative business. If you are doing intraday, you will have a loss. You can set it off your losses from intraday only against profit from intraday. Rest, everything is not allowed to be set off. I hope this is clear to everyone. So this is what tax loss harvesting strategy is all about. So, you can let me know if you have any questions. So this is a strategy, but yes, because this is something which is very different, there could be some questions in your mind. So feel free to ask any of your questions. I'll be answering those. I can see some questions in Q&A. So let me just check there. Some of the questions, okay, some replies. Manish is asking, is 15% despite of overall income? What if person is in tax slab of 30%? Okay, Manish, I guess you are asking about short-term capital gain tax at 15%, right? So what happens is whenever you are investing into equity markets, if you're selling your investment within 12 months, it is short-term capital gain. You are supposed to pay 15% tax on the gain amount, irrespective of whatever slab you are in. So even if you are in a slab of 30% or a person who is in a tax slab of 30%, you are supposed to pay 15% taxation on short-term capital gains on equity investments on shares, listed shares, and also equity mutual funds. So I hope I have clarified your question here. Let me know if you have any further query. Ankur is asking now here if Rahul is planning to keep that booked loss equity for longer duration. See, basically, if you have booked your loss, so definitely you can set it off against your profit. You have reduced your tax liability. That is already done. Why I'm saying is invested again into the market is because you would want to have the same position as before. You were doing some investment for long term. So strategically, you can actually, it's not a hard and fast rule that after 2 days you will have to invest. You can look at the market. You can consult a financial advisor and see when to re-enter the market. But do not take too long. You just need to see that at the same price levels or slightly lower price levels to cover up the brokerages and STT, slightly lower also if you enter. That is good enough. So because you're doing it already for a long-term investment, but even once you sell it, your tax loss harvesting is done. You are able to save your taxes in the first transaction. Second one is done to make sure that you are there on line with your long-term goals. So you should be reinvesting it because you have invested it for long term. That is why. So I hope that is clear, Ankur. So another question, salaried, how may I set off long-term capital loss in financial year 2020-23? See, for long-term capital loss, like I mentioned, long-term capital loss can be set off against long-term capital gain. So if you have made any investment where you have made a long-term capital gain, you can set it off against it. Even if you're salaried, that is fine. But you can set it off against any long-term capital gain. So if you're trying to ask, this question is by Biswajit. So if you're trying to ask whether you can set off long-term capital loss against your salary income, that is not allowed. So you can set it off only against long-term capital gains, not against salary income. I hope that is clear. If you had a slightly different or something else you were asking, let me know again. Daniel is asking if mutual fund long-term exit profit is less than 1 lakh, can I use it to pay off home loan? See, if it is less than 1 lakh, you do not have to pay any tax. And if you are booking that profit, you can use it to pay off your home loan as well. Again, it basically, the question here, it depends more on what is your requirement. If you're doing that investment for some long-term goal, you need it for short-term goal, when you need that money, then you should stay invested for that particular investment. If you're paying off your home loan, is that home loan or the home that you have is a second property, or it is a property where you're staying right now, In that case, if you're staying in that property right now, then I would suggest, Daniel, that keep in mind about your liquidity needs as well. So it might happen that, once you book your profit, you pay off your home loan. It's basically going into that home and you're staying in that home. And if you're staying in that home, I'm assuming that there's no plan to sell that home, for the near future. So your liquidity should be well maintained in hand. If it is invested into mutual funds, you will know that, yes, in case of emergency, anything, I have that money. But if I book my profit, pay off my home loan, then you will be letting go of your liquidity. So keeping that in mind, also you need to take decision rather than just by, just booking profit and paying off your loans. And yes, generally, if I say for long-term perspective, it is good to make a strategy to pay off your loans as early as possible to save on huge interest cost. So another question we have, if I reinvest it, then again, I have to wait to complete the exit period of the equity mutual funds. Yeah, it depends upon, if there is some window of where some exit load is charged. For that, you need to stay invested. Now, it depends upon which kind of a fund that you're investing in. But yes, to clarify that, you will need to complete. But again, what we are trying to understand here is it's not something that you keep on investing and you also, exit from your investment. It is more from a point of view that once you invest or once you do this tax loss harvesting, you're trying to save your taxes. So once you reinvest, it will be for longer period of time until unless next year, if there is some tax loss harvesting again you are trying to do and you would want to exit, then you will not identify those funds which funds are still in their lock-in period, or at least not lock-in period as such, but where the exit load will be charged if you are, shifting your money too often. Tax submission is after the financial year ends, and how to realize loss during the same financial year. Yes, Rupesh, that is what you need to do. Return filing is what you need to do in this return filing. When you do it is, usually in the month of July, 31st July, before that you need to do it. But whatever transactions that you're making, those transactions basically you need to do till 31st March itself. So it similarly, how you are doing your salary income if you're earning, or any other income that you're earning, if you're doing any ATC investment, all your investments, tax saving investments, tax strategy needs to be done in the financial year itself till 31st March. But then you declare it afterwards and then you pay additional tax or you get a refund depending upon how you're filing your income tax returns and how you have made your tax planning strategies. But this thing needs to be done before 31st March, because before the close of the financial year. That is what you need to do it. ITR filing will be done after 31st March is over, usually in the month of July. I hope this is clear, Rupesh. Let me know if you have any more question. This will change the investment date and have LTCG and STCG implications. Yes, that is what I think we have discussed. You have asked this question long back. Just to save 30,000, why should we book a loss of 2 lakhs? Maybe in long term, 2 lakhs might be recovered. This is just one example. It might happen. See, when we are booking the loss, it's not, you're not getting the same thing. See, now if I see my investment portfolio, I see there's a loss of 2 lakhs. I have just made a transaction, booked it, and again reinvested. So my 2 lakhs is still invested into the market only. So I have not actually taken that heat of, taking that loss, because that was already there in my portfolio. I am not making any loss. I'm just identifying if there's any loss and just making use of it to save my tax. So it will not impact. So the question that you're trying to say is something very different. It's something like I'm trying to create a loss. So that is not there. Loss is already there. I'm just booking it and reinvesting it to save my tax. The position in the market and whatever the stocks and mutual funds I'm investing into, that remains the same because I've reinvested. Okay. I hope that is clear, Pragati. So these are okay. Is it mentioned in Form 16 by default, or do we need to mention? So this will not be mentioned in Form 16. You will have to declare it. You can find, whenever you are selling your mutual fund or stocks investment, you can find those transaction details in your Form 26 AS. There you can check. So Keyur had asked this question. So Keyur, you can check it in your 26 AS. Once you have done those transactions, it will reflect there in your 26 AS. Whether LTCG, so Dr. Harsh Kumar is asking this, whether LTCG, STCG and intraday net profit are added as additional income and taxed again as per slabs, or it's only as 15%. So Dr. Harsh Kumar, basically you have combined three things and saying 15%. I'll clarify again. Long-term capital gain tax rule is different, which is 10% over and above a gain of 1 lakh. Short-term capital gain tax is 15%. Intraday, it will be added into your income and will be taxed as per your slab rate. I hope that is clear now. Long-term capital gain 10%, short-term capital gain 15%, and intraday will be added to your income and will be taxed as per your slab rates. So once you have paid your tax on long-term or short-term, like separate rates are there, you will not have to pay it again as part of your income. Okay, I hope it is clear. If short-term capital loss is less than long-term capital gain, less than 1 lakh, do we need to show both loss and income tax filing? See, whenever you're making any gain, you need to show it while filing your income tax filing, whatever be the amount. You should declare it. Even if it is a long-term capital gain, it is less than 1 lakh, you will not have to pay any tax for long-term capital gain, but you still need to declare it while filing your income tax, filing your returns. From where to get profit and loss statement to get mutual fund summary before 31st March. Wherever you are investing your money, Rupesh, you can just check the mutual fund statement from there only. You can ask them. You must be getting on your email also. You can just check the portal where you are investing, and there will be an option to download it from there. If you need any assistance to, in there, how to extract information or to calculate for your own taxation, feel free to get in touch with our finance and tax experts. You can see the email ID and the phone number already given on the screen here. So feel free to reach out to our team if you need any personal recommendations or personal guidance in how to do the strategy for yourself or any other tax saving requirements that you have. You can do that. You can also book a 15-minute free consultation so that if any questions, queries you still have, but it's more on a personal nature that you do not want to ask on a public platform like this, you can get in touch with our experts for a 15-minute free consultation as well. Okay. So one more question Mahesh has, my ELSS SIP period is end. Should I redeem or keep it same current return IRR between 8 to 10%? See, again, Mahesh, this will be very personal in terms of, fund. It depends upon which fund it is when you had invested into this fund. So again, I would say, because I don't know the name of the fund, so this will not be the right platform to recommend on any of the fund names as such. But on one-on-one level, definitely our team will be able to help you on whether to continue with that investment or to take an exit. Looking at your risk profile, looking at your goals, looking at what you need, what your needs are for future, a financial advisor can guide you in the best possible way. Right? Shivram is asking a question. This tax loss harvesting has to be done on the last day of the financial year, anytime during the year. You can do anytime during the year. It's not that you have to do it on the last day of the financial year, but in fact, I would say don't, wait till the last day of the financial year itself. See, now we are in the month of December. We are just left with 3 more months. So if you have booked profit on any of your investment till now, what you can start doing is start monitoring your portfolio and see if there are any, already booked profit. So if you see any of your investments in loss, which can set it off against profit, you can book your loss right now. If you right now do not see any of your investment making a loss, then you continue with your investments. And in the month of Jan, you check once, or Feb, you check once, because of the volatility in the market at any point of time when the market is down, you can take that opportunity to book your losses and set it off against your profits. So this will be, based on that. Please send your contact details. It's already there on the screen, which is shared towards the end. Connect with us. Email ID is given and the number is also given of our team. Feel free to get in touch with us. Need assistance for financial planning? Definitely we'll assist you. You can reach out to us on the details given on the screen. Do we have any more questions? Okay, this loss. I guess I've answered all the questions till now. And I hope the session was informative for you all, and you all can utilize this strategy of tax loss harvesting, save money for you, and you can actually channelize those savings towards other financial goals that you have. Like I mentioned, if you have any questions, you can feel free to get in touch with our team for any further assistance. And thank you so much, everyone, for being there till the end of the session and also asking a lot of questions. and clarifying your doubts. It was great interacting with all of you. Thank you so much. Thank you so much, everyone.
Thank you so much, Nidhi, for the wonderful session. I hope all the queries have been answered. And thank you everyone for attending. And we'll be having another session on a new topic, on a very interesting topic again. So be updated on your mail and you'll be receiving further updates regarding our webinar. So thank you so much, everyone, for being attending and have a great day ahead. Goodbye to everyone.